Okay, so now we're going to continue with question 3. Now, question 3, if we move on to the you are required to, let's quickly see what are they asking you. Okay, so they've gone and split all the transactions into separate transactions. So what is required for each of these? They tell you to analyze each of the transactions listed above and complete the table provided in your answer book. So you have to complete the table and you have to analyze each transaction. Now, if you look at the answer book, it is, if I remember correctly, it is your accounting equation. So show the double entry, the debit and credit, general ledger names, as well as the effect on the accounting equation. So what they're testing is they're testing if you understand what is the account name, which account will be debited, what account will be credited. Then we look at the accounting equation. So is it falling under your asset category, your owner's equity category, or your liabilities? And then they tell you make sure that you use a plus and a minus sign to show the effect on the equation. Now, if you don't show these signs, a lot of the memos actually say that we're not allowed to mark it. So please remember to indicate the positive and the negative. And then they give you an example of what it should look like. So what you would see here is the numbers. So depending on the transaction, you put the number in there. Then you do the accounts, debits, and credits. Now, because of the fact that if I look at this, there's VAT in this question, what would sometimes happen is we might have two accounts on the debit or the credit side and only one on the other one. So you would use two lines to capture the transaction. Okay. And remember that whatever's on the asset side needs to equal what is on the owner's equity plus the liability side. So that is how you know if it is actually balancing. So this needs to be equal and we need to add this together. So that would mean if I take the 522 here, add it to the 3478, that should equal to 4,000. That is how you test in a test or an exam whether you have balanced your accounting entry. Because what have happened in the test is a lot of students, they would forget this amount there, but they have that amount correct, and then it's not balancing. Okay, so that is just something you guys need to look out for. Okay, so let's go through the transactions and then we capture them in the format that they asked. Okay, so let's start with the information. They tell you we sell vegetable seeds to farmers. We track their inventory according to the periodic inventory system. Now, when you see periodic, you need to remember it's in purchases account, which is an expense account. Okay, so that's the first thing you need to see because that is going to impact your accounting equation whether you include it under the asset or the owner's equity account. Then they tell you all amounts include VAT at 15%. So this means your amounts are inclusive of VAT. Okay, so that's the other thing you had to note. Okay, so now let's go through each and every transaction and then we capture it on the accounting equation. So the first thing is we had credit sales for the week with 838,350. Okay, so what will we debit? What will we credit? Okay, let's quickly see if I open here, if you can see the Excel. Are you guys seeing the Excel file on your side? Okay, I'm just gonna go through all the transactions and then I'll open the Excel. Then we don't have to flip through the accounts. Okay, so I'm gonna start with the PDF and then share the Excel with you guys. Okay, so let's start with the first one. So if we have credit sales, that means we've purchased it on credit. Now, when I've got credit sales, it goes to debtors control. Okay, because it's on credit. And then the other account is the sales account to account for the sales. Now, what am I going to debit? What am I going to credit? Okay, and we're going to credit debit debtors control because they owe us money, so that increases. We credit our sales. What else do I need to credit? Okay, what VAT? Output or input? Okay, and then we credit VAT output because that is a liability which we need to pay over to SARS. Then if we purchase new equipment of 545,000, now here they tell you it's VAT exclusive, so be sure to note this. This one is an exception to the rest of it. So we purchase it on credit from total equip. Now if we buy something on credit, here we are buying it ourselves. So we're going to debit equipment, so that is what we've purchased. We're going to credit creditors control because we bought it on credit. And what side will the VAT be on? On the debit side. And we will then have the input VAT that we claim on that asset also on the debit side. Now, because this is VAT exclusive, we will have to go work out for creditors control the VAT inclusive amount and then also the VAT amount for the input VAT account. Then the next one, owner withdrew 5,000 cash for personal use. So this is drawings. Okay. So we will debit drawings and we will credit bank because we're taking the cash out of that. Do we need to account for VAT on this transaction? Okay, in this instance, no, there's no VAT because of the fact that it's a physical cash transaction. Okay, if it was goods that we had taken out, then we would have to reverse the input VAT that we claimed and raise output VAT for that transaction. Then we made repairs to all the equipment and paid for it in cash for 10,350. Okay, so we paid cash and it was incorrectly debited to equipment. So this was an error. Okay, so what they then tell you is the VAT portion was correctly treated. So where should it have gone initially? So initially we should have captured it to our repairs account, but then it was taken to our equipment account. So this is just to correct the account name. So we would debit your repairs account and we would credit your equipment account just to reflect it in the correct category. Now, because the VAT portion was correctly treated, we do not need to take VAT into consideration at all. Okay. But what we need to remember is that these amounts need to be exclusive of VAT. Because the VAT would have been initially removed from that amount. Okay, so that's what you had to see there. Then if we purchase furniture for staff recreation area, for 3,500 and we paid for it by check. Okay, now we would debit the furniture because it's an asset. We would credit bank because we paid for it by check. Do we account for any VAT on this transaction? Okay, so the class thinks no, and the answer is there is no VAT on this because input VAT has been denied because of the fact that it is staff entertainment. Okay, so in this transaction, we do not account for VAT because of the type of transaction we have. But the mark allocation should have also indicated what it is. Okay, the higher the marks, it means the more complex the question. If there's a low amount of marks, it's generally 2 entries and then just the amounts in the correct categories. Okay. Then 3.6, we returned damaged merchandise to a creditor and we received a credit note. Okay, so because we gave it to our creditor and we returned the goods, what would happen is creditors are normally credited when they increase. So when we decrease it, we debit creditors control. Then we credit our inventory. Okay, what do we need to do with the VAT? Where does the VAT go? Okay, where does the VAT go? Okay, so my lady says we need to debit the VAT. Okay, so my lady, normally we would debit the VAT when we recognize the inventory. But because we are returning the inventory, we would now create output VAT. Because we claimed the input VAT initially, but now we have to raise the VAT again because we are returning it. So we are reversing it to the opposite account. Okay. Because your creditors control would be inclusive of VAT. To balance the credit side, you would add the VAT that side because the inventory would have been exclusive of VAT. That's also how you can think about it if you're unsure. Okay, then 3.7. Okay, Seeds for Africa has a loan from Needs Bank. The capital amount owing is 100,000. Interest is charged at 7.5%. The interest was paid via EFT. Okay, so what you need to see here is how much capital do we owe? What is the interest per annum? And then that we paid it via EFT. So you would have to go calculate the interest amount that was paid. Now what we need to look at here, is it for a month or is it for the entire year? Now this is only for a month. So this means I will only calculate interest for 1 month. Okay. Now because I am paying the interest, we would say interest expense, or it's actually interest on a mortgage loan. Or you can say interest expense. And you would credit the bank. And there would be no VAT on this transaction because interest is an exempt supply. Okay, so interest does not attract any VAT on it. And then the last one, or 3.8, is a check of 2,345 was drawn to restore petty cash. So what that means is I've literally taken money out of my bank account to top up my petty cash. Now petty cash is an asset, so we debit petty cash with that amount, and we credit bank with the money we've taken out. And because it's only physical money, it does not have a VAT component. Okay, so those are the 8 transactions. So now I'm going to stop sharing this screen, and then I'm just going to share the Excel with you guys. Okay, so for the first transaction where we had credit sales, your transactions would look as follows. Let me just make this slightly smaller so that it would fit on the screen. Okay, so they would have provided you with this table. So you would have debited the debtors control account because we purchased it on credit. You would have received a mark for that. Then you would have credited the sales account, and that is the VAT exclusive amount, and you would have credited the output VAT account. Now, debtors control is an asset account. So for that reason, I increased the asset account with the full amount, which is the 838,350. Okay, so the amount inclusive of that. Then sales falls under owner's equity, but it increases your owner's equity, so that's why we've got a positive. But I need to remove the VAT amount from it. So that's why I multiply the amount they've given to us with 100 over 115 to remove the VAT component. So you would have received the mark for the calculation and half a mark for showing the correct amount in owner's equity. Then output VAT is the money I'm paying over to SARS. That is a liability. So the VAT component then goes to the liabilities account, and you could either just deduct it from the assets to get to the liabilities amount, or you could show the calculation and you would have received the mark for that. Now let's say you made an error with the calculation. You would get a method mark either generally for the owner's equity if your VAT was calculated incorrectly, because you would have deducted it and got to the balancing amount. Okay, so that's the first transaction for the credit sales. Then transaction 2, where we purchased the equipment, we said equipment would increase. We bought it on credit, so creditors control would also increase, and then we would claim input VAT on that. So because they told you it's equipment, the account name is equipment, the input VAT that we would claim on that equipment. Now remember, equipment is exclusive of VAT, so the amount they've provided for us would be the amount that is assigned under the asset category to that equipment account. Then the input VAT we need to go calculate. Now that is the amount exclusive of VAT multiplied with 15%, gives me the VAT that I claimed amount. Okay, a little bit. How big do you want me? Okay, then I'll just move to the right-hand side. Okay, so the guys online, I'm just zooming it in because the guys in class can't see, so I'll just scroll to the right so that you guys can follow as well. Okay, so the input VAT is then 15% of the VAT exclusive amount that was provided to us. And then the creditors control, remember, is always inclusive of VAT, because this is what you physically have to pay over. You're paying the amount for the goods as well as the VAT that they have to pay over to SARS. So what you could have done is you could either have added the VAT exclusive and the VAT amount together to get to the 626, which falls under your liabilities, or you could have done the calculation by adding the VAT on. Okay, so you could have done either or, and you do actually receive a mark for the calculation. If you don't show the calculation the amount is correct, we would assign the calculation mark to it. It's only where your calculation is incorrect where you would lose a mark if I can't see what you used. Okay. Can I move on to the next transaction? Are you guys okay? Okay, transaction 3, we said the owner took money for his personal use. So we said it's owner's equity, which is the drawings account. So we start with drawings that we debit, which falls owner's equity. Now drawings reduces your owner's equity because we're taking our money out of the business. And then we credit bank, and we also reduce the bank balance. That's why it's a negative asset amount. And we say because of the fact that it's physical cash, there is no VAT component. Okay, then 3.4. We purchased the furniture for staff recreation. Okay, and we pay for it by check. Now in this instance, we will debit. Oh, sorry, 3.4 is the repairs. Sorry, I skipped over that. Okay, so this is where we're correcting the account. So we said we should have taken it to repairs, but we accidentally took it to equipment. So what we do is we debit the correct account, which is the repairs account. We credit the equipment account. Okay, but the amount that they've given to you there is the 10,350 is inclusive of VAT. Now, when we captured the initial transaction, we would have removed the VAT from that purchase. So when we transfer it to the correct account, we are literally moving the VAT exclusive amount from the one account to the other one. So we take the 10,350, we multiply it with 100 over 115. Did I calculate it incorrectly, Daniel? Okay. So that's how you get to the 9,000. So that means because equipment is now credited, we are reducing the asset with 9,000. And because we are debiting the repairs account, which is an expense account, we will decrease owner's equity with that amount. Okay, so expenses reduces our investment in a business. Then if we look at 3.5, we purchase furniture for staff recreation area. Now we said, because it's for entertainment purposes for your staff, it does not have a VAT implication. So we would only debit the furniture and we would credit the bank with the amount that we paid. Okay, so you can either take it to equipment or furniture. They would have marked either correct. But because of the fact that they use furniture, I would advise just use the lingo that's provided. You would credit the bank amount. Now, we would include the VAT in this transaction because we can't claim the VAT. So that means our bank, as well as furniture, is sitting under your assets account. So we increase and decrease it with the 3,750. Okay, so you would have made a positive and a negative amount in this column. Then 3.6 is where we return the merchandise. Now, yeah, because of the fact that we use the periodic system, we won't take it to from the inventory account. We would actually have to take it to purchases. And if you just unhide the information. Okay, so firstly, you debit creditors control. Then you credit purchases return account. If you have purchases, they might still give it to you as well, but there's also, just like sales returns, we've got a purchases return, and we would raise the output VAT because we would have claimed the input VAT initially. So when you return it, you raise output VAT on it to net off the input VAT you claimed. Okay, now creditors control is a liability. So I would reduce my liabilities with the 18,400 that was provided. So that's the amount inclusive. Okay, output VAT is also a liability, but we are increasing that account with the VAT component, which is the 18,400 multiplied with 15 over 115, which is the 2,400. Now if I add the negative and the positive together, it should be the same as the owner's equity amount. And if I add all of this together, it should actually be 0. No, one of the signs are incorrect. Let's quickly see. Okay, so creditors control is reduced. Okay, yeah. After that is increased. Okay, this is not a negative. Okay, so because we have purchases returns, it is actually increasing our owner's equity because of the fact that we reducing the expense. Okay, so purchase return is actually money is coming back in. So this is a positive. Now, how do I actually know I made a mistake here? Because of the fact that we said assets equals owner's equity plus liabilities. Now, if I have a negative here and a net negative under liabilities, I will actually have a negative 32,000, but I've got nothing under assets. And that's how you know you've made a error. So this is actually a positive. The owner's equity is positive, and then the liabilities is a negative 18,400 as well as a positive 2,400, which is a negative net 16,000. It's this purchase returns will increase your owner's equity because it's actually an income as opposed to an expense. Okay, so that is transaction 3.6. Transaction 3.7, we said we paid over the interest amount. So you had to calculate the interest for that specific month and deduct it from our bank account. So let's start with interest on loan. Now, if you did interest on loan or interest expense, we would have given it to you. Credit the bank account, so the amount of money we're going to pay. But now we have to calculate the interest. So you take the balance outstanding, which is the 100,000 per the question. We multiply it with the 7.5%, but this is a per annum rate. So that means it's for 12 months. But now we only want to calculate interest for 1 month. So we multiply it with 1 month, divide it by 12 to get what is the interest for 1 month specifically, and then we account for that on its own. Now, interest on a loan account, an expense account, which reduces your owner's equity, whereas bank is an asset account and it reduces when we pay the interest on the loan. Okay, everyone with me so far? Okay, then the last transaction, a check for 2,345 Rand was drawn to restore petty cash. So what I said is we literally taking it from our bank account and putting it into our petty cash box. So we're moving it from one asset account to another asset account. And because it is cash, there is also no VAT implications. So we would debit the petty cash because we're increasing the petty cash. We credit bank because we're reducing the bank, and then we've got both a positive and negative asset account in the scenario. And that is how you would have completed question 3. Yes. Where are you? Yes. Oh, those are little tick marks. So those are little half marks. So that's just the mark allocation. Okay, so on the spreadsheet, if you see a normal tick mark, it's 1 point. If you see it looks like a little, I don't know what to call it. Almost looks like a hat, but not exactly. That is half a mark. So If it's not a normal mark, it is a half a mark symbol that. Okay, so that's just the mark allocation, how they sort of allocated the marks. So normally with this type of question, if the amounts were given to you, they assign half a mark. If you need to go and calculate the amount, the amount can be a mark up to 1.5 marks will be assigned to that value. Okay, so that's a general principle if you want busy with the exam and you're not sure how much you should write. Okay. Okay, the guys online, do you have any questions on question number 3?